should you be worrying about your money? The Bulls and Bears are here to help. Hi, everyone. I'm Brenda Butner. Let's get right to it. Here they are, the Bulls and Bears this week. Gary B. Smith, Jonas Max Ferris, John Layfield, along with John Tobacco and David Mercer. Welcome to everybody. Okay, John Tobacco, a wild week. What does it mean to our viewers?
Brenda, what I think this means to our viewers is they should be very concerned going into Monday morning. We've had an enormous run-up over the last few months, even the last year, and people have a lot of profits on the table. What we're seeing right now is a lot of the artificial stimulation the market has gotten by Ben Bernanke's policies is starting to come to roost, and our fund feels like the stock market right now has a correction in mind somewhere in the 5 to 7% range over the next quarter. I could look for somewhere in the course of this week about 1,000 points to the downside.
Wow.
If I was a retail investor, I had some profits, I would go into Monday morning thinking, let me take some profits off the table. If the bubble starts to burst, there'll be great opportunities down the line. But the prevailing opinion is always sell in May and go away. We're in June. If you haven't sold yet, I'd be selling Monday.
Boy, 1,000 points. Gary, are you buying or are you selling?
Well, first of all, John just scared the heck out of me. So I don't think, well, okay, look, here's a couple of things. I agree with him in part of it. I do think there is more downside. I don't think it's going to be another 1,000 points down. That would take us below Dow 14,000. I think that's probably a pretty safe stopping ground. In direct answer to your question, yes, I started buying late Thursday. I started buying a little on Friday. If stocks drop a little bit more, I will buy a little bit more. I would say, just to put in perspective, viewers, I'm probably about 70% invested. So I'd actually like to see a little bit more downside in order to buy more. Overall, am I worried? Is that as pessimistic as John? No. I think this is a temporary pullback and probably more a good buying opportunity than anything else.
Well, John Layfield, the market has gone very far, very fast. Isn't it time for the Bulls to take a breather? I mean, the Dow is up 13% so far this year, even though it did have a couple tough days last week.
Sure, and look what happened in Japan. You had any type of negative news that they went almost straight up, and they've come off significantly off their highs. Look, this market was about 12,500 a year ago. It's just short of 15,000 right now. So I think it's normal that anytime you have any type of perception of bad news, people start taking money off the table. But you got a buying opportunity if we go much lower here, because the Bernanke says that he's not going to raise rates until employment gets down to 6.5%. And once you start seeing the economy get better, look, 10 of the last 11 Fed tightening cycles, the market has gone up. But once you start seeing employment get a little bit better, more people go in the workforce, it's going to take a while before they raise rates.
But, David, this has been a bond buying binge. Now, if it stops, if the Fed pulls back, isn't that a sign that the economy is improving, and isn't that good for the market?
Brenda, I think you're absolutely right, and it's a return that we can rely on the fundamentals of the economy. You have the jobless rate being reduced, you have housing up, and you have corporate profits at all-time high. And so I think it was an indication by Bernanke that we are seeing these indicators and these good forecasts, and that please look at this, because we may, if we hit 7% unemployment, start putting on the brakes as it relates to easy money, if you will.
Well, Jonas, is this a bubble about to burst, or are we about to see what happened to the housing market?
No, in fact, what I think happened is a bubble was starting to form because of the low rates. The market was getting ahead of the real economy, which is still a little lackluster in a lot of areas, especially employment. And what the Federal Reserve wants to do is keep keep encouraging growth in the economy, yet stop an asset bubble from forming like we had in real estate during the last bout of low rates in the 2000s. So the idea was to talk down the stock market, and it worked, and maybe keep the heat on so we can still not have to pull the stimulus away. What you wouldn't want to have to do is, because the market goes to Dow 18,000, have to start raising rates everywhere and then cause a recession for no reason. So it's a very touchy, dangerous, hard to play game, but that was the strategy. And in general, you want to be in an economy where we don't have to have a Federal Reserve creating money out of thin air to buy debt. That's not a natural state of things or healthy in the long run. So it's two positives. You look at it that way this week.
Yeah, but John, what do you say to that?
To David's point, I don't see any of the fundamentals he's referring to in the marketplace. I see stagnation in GDP. I see continued deterioration in U6. I see capacity utilization up, but underemployed and part-time employment up. So I don't see any of those good fundamentals. And what I do see is Ben Bernanke's policies are like Bernie Madoff and Alan Stanford on steroids. They've been artificially stimulating this marketplace because when people get zero return on their bank account, they're forced to go to one place and take some risk and get return in the marketplace. So he's forced people into the markets, and that bubble is existing. That bubble is getting bigger, and I think, you know, I know everyone thinks I'm a little pessimistic, but I'm the canary in the coal mine. I'm the canary.
What about
in the coal mine.
6.8 million jobs? What about 6.8 million jobs over the last 37 months? That is a fundamental fact that we need to address, and that was addressed by Bernanke in his speech on Wednesday.
Well, Gary B., do you agree that the economy is on solid footing?
Well, I think it's kind of mushy. Let's put it that way. And I think the only number that we need to know, John Layfield identified it, that Bernanke's not going to really take the foot off the accelerator until unemployment is 6.5%. Now, we all know, I think everyone here, that under the current administration, we're never going to see 6.5% unemployment. So party on until 2016.
Well, but Jonas, rates have gone up. If we see interest rates go up, what does that do to the market and to the economy?
That's your real danger, because we just saw, you know, a few weeks ago it was 1.6% on a government bond, and now it's 2.5 basically. Now, well, who cares? Well, that's where they set mortgage rates from. So if you try to get a mortgage 6-8 weeks ago, you might be able to lock a 30-year loan at 3%. Now it's pushing 4%. That's a big difference in how you value a home, which have only recently started to go back up, home prices. So this is the market behaving. This isn't the Federal Reserve. And that's bigger, unfortunately, than the Federal Reserve. If this continues and we go to, say, another % up rapidly in a few weeks, you're going to see housing prices start to go down again and this recovery ending. So we don't want it to go too far. But I do think a little of this was good because it was taking the heat off the stock market, to John Tabacco's point. We don't want to have really artificially low rates. But I think the current economy deserves rates at about today's level right now.
John Layfield, does that worry you? The housing market is one of the few positives in the economy right now.
Yeah, but I don't think rates are going to go up significantly for a matter of time. Look, you got to understand, to David's point, that 8% was the benchmark brought up by the administration, saying, hey, give us all this free money. It will never go above 8%. That proved not very prescient. What you have is a structural unemployment issue, not a cyclical unemployment issue. So you can leave rates at zero forever. It's not going to significantly help that. The market rebounding will help that. Bernanke was 100% wrong on trying to deal with something that is a structural issue, not a cyclical issue. Is going to do more for this economy than Ben Bernanke is going to do.
Okay, that's got to be the last word. Thanks, guys. From a rock